In this video, we're going to show you how to use time frames effectively, a key in avoiding stop loss hits and fake out reversals. So make sure you watch until the end to get the exact tools you need to become profitable. This is the 1 hour chart. Price formed a double top rejecting resistance before breaking below the neckline, signaling the start of a trend continuation. Price then pulled back to the neckline, now acting as resistance, and formed a long wick candle rejection. The longer upper wick shows the loss of bullish momentum as it failed to close higher, signaling profit taking and selling pressure entering the market. If we zoom in to the left, we notice that the same candle rejection led to a reversal. This means that right before a trend change, price formed similar candlestick pattern because of similar trading actions being executed, which lead to a reversal. But we are not saying you should open positions every time price forms this candle, because as you can see up here, the same candle rejection formed, and if you've entered right away, you would have been trapped and lost your money. So you are thinking to yourself, how do I know if price will reverse or not after a rejection? You need to wait for the next candle to close, giving you confirmation of who is in control after the rejection. If the candle closes fully below like this, that's a clear sign the sellers have taken over, a green light for you to go short. But in this case, the green light came in much later, meaning your entry would have been way down here, which is a problem because the counter target still needs to be above the level. This is where time frames comes in. If you were watching the 15-minute chart along the 1 hour, you would have seen a bearish close much earlier, giving you a cleaner low-risk entry with a better reward. Multi-time frames gives you an edge, allowing you to take advantage of trade setups in their early stages. But before we dive into the technical know-how that will level up your trading, hit that subscribe button and turn on the notification bell to not miss out on what's coming next. This is the USD/JPY on the weekly time frame. Price was bullish before pulling back to support after this high formation. When price reached this zone, bullish momentum faded, presenting a perfect opportunity for sellers to step in, causing a reversal. This reaction tells us this area holds significance. Both buyers and sellers are watching it, because it has proven to be a turning point where the balance of power between buyers and sellers can shift. So when price returned to the level, the shrinking candlestick pattern appeared, signaling trend exhaustion, a loss of bullish momentum. Once it hit the level, the inside bar formed, followed by a candle color shift, indicating profit taking and early bearish pressure entering the market. The longer upper wicks shown rejection, meaning buyers tried and failed to break higher. This is where we bring in the lower time frame to analyze price formation within these candles. Here on the daily, price created a double top rejecting resistance, adding more weight to the bearish setup. Even though the daily swings were not fully defined, they supported the idea of sellers stepping in. Eventually, price broke down, forming a lower high and a lower low, breaking below the trend line, finalizing the confirmations, aligning with the weekly bearish price action. The selling pressure then entered the market, kicking off a solid downtrend, pushing price below the daily support. When price returned to the support, now acting as resistance, we had multiple long wick candles rejecting resistance, indicating the end of the pullback. The rejection hinted a possible trend continuation, which was confirmed by the trendline break below on the 4 hour, giving us a clean re-entry point for the bearish move. Now that you know how to combine multi-time frames with key levels, here is a bonus technique to use in heavily trending markets where there are no key levels to be found. This is the recent pullback that happened on gold. If you are watching the 2 hour time frame, you would have spotted this reversal coming right after the shrinking candlestick pattern, which indicated waning bullish momentum. This was followed by the candle color change to red, suggesting a potential sell opportunity. The subsequent formation of the bearish engulfing candle confirmed the reversal, signaling bearish momentum entering the market. Now, since this was a counter-trend trade in a heavily trending bullish market, a strong bearish price action was required to validate the reversal. Notably, the bearish engulfing candle contained a fully formed downtrend, characterized by a lower high and a lower low breaking below support. As price returned, a double top formed accompanied by a lower high rejecting resistance. This rejection also aligned perfectly with the trend line, creating an A-plus setup. Furthermore, the bearish momentum crossed below the 5-minute trend line, triggering a bearish move. The confluence of this price action, including the candlestick pattern, trendline alignment, and the confirmed momentum shift, provided a high probability trade setup that yielded a substantial drop in the gold prices. Now, if you want to see the strategy in action, check our live demonstrations on Facebook. The link is in the description below. And if you found this video helpful, give us a like, subscribe, and stay tuned for the next one.